This is a podcast from the Business Times.
How costly is your integrated shield plan? At the end of August, right when this podcast is being recorded, the 2-year moratorium for premium increases for integrated shield plans, called IPs for short, comes to an end. Already some insurers have indicated to me that they will raise premiums. This comes at a time when almost all IPs fared worse in their underwriting results for 2023. They either incurred losses or their profits were sharply reduced. Health Minister Ong Ye Kung has sounded a stark warning about what he sees as unhealthy competition in the IP market and the trend in premiums. IP insurers, he said, risk a race to the bottom. What do these trends mean for you? Should you switch your IP insurer? Do you even need an IP or a rider? Welcome to Wealth with BT. I'm Genevieve Cua, Wealth Editor of the Business Times and your podcast host. I have a guest in this episode. Eddie Cheong is Chief Executive of insurance advisory Haven, and he's going to help us make sense of the developments in IPs. Hi, Eddie. Thank you for joining us.
Hi, Genevieve. Thanks for inviting.
Let's dive into it. I'm sure many of your clients worry about the trend in premiums, especially those who hold private hospital plans. As far as you can gather in your dealings with IP insurers, by how much are premiums likely to rise?
All right. Thus far, there are 3 providers that have given notices of premium increases. They are from Income, Singlife, and AIA. So from next month onwards, the new premiums will kick in. For Singlife and AIA, only the private hospital plans and the corresponding riders will be affected. The lower plans are not affected. For Income, the premium revision applies to all classes of the plans as well as the riders. As a rough estimate, the increase in IP, depending on the age band, can range between single digit to as much as 30%. For the riders, especially for private hospital plans, the increase of IP riders can be almost 100%. But actually, the 2 years premium moratorium only focuses on the IP main plan. Insurers are free to revise or increase the premiums of the IP riders during this period. In fact, there are a few insurance companies that have revised or increased. They are from AIA, Prudential, GE, HSBC Life. They have increased their IP premiums over the past 1 year. Since they have already revised recently, they may not be too keen to make another revision anytime soon. With the latest premium increases, it's not surprising that some IP that has been among the cheapest now could be the most expensive. But you will probably see a reversal of trend after a few years.
The numbers you've given sound very steep. The Health Ministry has indicated that older people over 60 are giving up their IPs, at least some of them. This comes at a time when they're more likely to begin to need more health care. How essential are IPs and riders? I've told you earlier that I myself don't hold a rider.
That's right. It's actually not compulsory to have an IP plan. So if you are okay with subsidized wards like B2, C wards, in that case, your MediShield Life is good enough. And the good thing is that it can be covered by your CPF savings. But if you like to have more amenities like air condition, more privacy, able to choose your doctors, or even going for a shorter waiting time, then you really need an IP that matches your healthcare expectations. Otherwise, your MediShield Life is not enough, and you will end up having to pay bulk of the hospital bills on your own, which can be quite hefty. So therefore, you probably need an IP plan if you have high expectations. As for the IP riders, it serves 2 key purposes. Number 1, it helps to waive off the deductible and co-insurance. And secondly, it also double up as an additional cover for cancer treatment, which is becoming important because the amount of cancer benefits in a main IP plan is now much reduced. Typically, I would say that if you are going for a private hospital treatment, if you have private hospital plan, you should consider having the rider. And the reason is because the cancer treatment in private hospital can cost a lot more than the public hospitals. And it's likely that the IP benefits is not enough on its own. You likely need a cancer benefits under the IP rider to be adequate.
It's estimated that around 3 million Singapore residents hold an IP. The MOH recently published stats on the lifetime premiums you'll pay for your IP, which I found very eye-opening. How does this data help in picking an IP? In fact, what's the sensible way to choose an IP for those who may be healthy enough to make a switch?
Right. The chart is actually very useful. You know, when people buy an IP, they usually are more focused on how much it costs right now. But if you know how much it will cost over the lifetime, you may think otherwise. So in choosing an IP, ask yourself these fundamental questions. First, what is your healthcare expectations? With the MOH chart, you can now know better how much it costs for certain ward types of your choice. So if you're looking for a private hospital plan, okay, the chart tells you that the lifetime premium could cost around $230,000 to $330,000. For public A ward, it will cost about $90,000 to $140,000. And for public B1 ward, it can cost $60,000 to $100,000. So now that you have the cost, you can make a better decision which plan, which ward type is more affordable for you. The next step is to choose which IP providers offer the best value in terms of costs and benefits. You know, the core benefits of IP across all insurance are more or less the same. But every providers want to be different, and they offers unique fringe benefits such as the longest pre- and post-hospitalization benefits, or some even offers treatments out of Singapore. So I would say that go for one that offers the value that's important for you and at a price point that you're willing to pay.
We've just been chatting with Eddie Cheong of Haven about integrated shield plans. When is a good time to switch your IP insurer? And more importantly, how can you save on premiums? More on this in a few moments.
Money Hacks now comes to you every Monday. Get useful financial tips every week. How much to save, what to invest in, how we ask the experts, so you have the answers. Money Hacks by the Business Times. Every Monday, go to bt.sg/moneyhacks or wherever you get your podcasts.
And now, back to WealthBT from the Business Times.
Welcome back. Eddie, how can laymen like us ascertain whether an IP is well managed and that premium adjustments will be reasonable?
Well, the short answer is very difficult, even for professionals, practitioners like us to guess correctly. You know, how providers set their premiums can be due to a few factors. Firstly, the cost of running the business, which is make up of the management and distribution costs. This one, by and large, you can control, you can identify. Second, the claim experience. And thirdly, competitive pricing to capture market share. You can find this information on the MAS website to show you how the providers are faring in terms of underwriting profit and loss. And you will realize that many providers are losing money. So generally, providers that keep losing money will naturally have to raise premiums later to make it sustainable. But what is perhaps the hardest to forecast is the future claims experience that the providers will face. And this information is not available to the layman. So if the claim experience for the providers is bad, meaning that having more than expected claims payout, then at some point the IP would have to increase the premiums to make it sustainable.
It's interesting that the size factor, how does that play into how, a customer can surmise how healthy the insurance pool is?
Yes, that's a very good question. The size of the risk pool is very important for insurance. In general, the bigger the size, the bigger the ability to manage the claims through the averaging effect. Beyond the size, there's also other criteria that will influence the underwriting profits. One of them could be the demographics of the risk pool. If the demographics are typically the younger policyholders, okay, usually the probability of claims is lesser. But if, let's say, the risk pool is aging, a high percentage of older policyholders, usually the claims rate will be much higher.
I had told the contact that I felt that this was something that should be made transparent, the composition of the risk pool. But then they said, we don't even know ourselves. And this is an insurance body, so it is kept close to the insurer's chest.
Actually, there are information that's available in terms of number of policy holders.
Yes, number.
Okay.
Yes.
Yeah. So typically, the four bigger players will be the AIA, Prudential, GE, and Income.
What are the telltale signs, if any, that a switch of IP provider may be warranted?
Well, if there's a mismatch in the costs and benefits that you're looking for in IP, then that could warrant a reasonable basis to switch. For example, if you want an IP that offers planned overseas treatment, not every IP provider offers that. So go for those if that's important to you. But I don't think you should switch providers just because your current IP has recently raised the premiums. And that's because from history, you can tell that every providers will increase their premiums at some point. So what may be the most expensive now may become the cheapest in the future. So for me, I will advise you to monitor the premiums for a few years. And really, if the premiums is always been on the higher side than the rest, then do reconsider. But of course, you need to be in a very good health to be able to do the switch. So typically, when you are young and healthy, you have the option. But if you are older, say above 60 years old, then I would tend to dissuade the switch because there may be pre-existing conditions that we are unaware of or have forgotten in the disclosure, resulting in complication in claims in the future.
Yes. So how can people save on IP premiums? Because I myself downgraded from private hospital to Class A plan.
Yes, that's one of the ways to do that. So I will suggest 4 ways. Firstly is to move to a cheaper IP providers. But this approach may not be a foolproof approach because as I mentioned just now, premiums that are cheaper now or more expensive now may become cheaper in the future. Second, you can downgrade to a lower plan like you. The savings can be quite significant. And if you are doing this, it's better to downgrade within the same providers so that there's no need for underwriting. And thirdly, you can opt for a cheaper rider or drop it completely if you don't need it. But make sure that there is sufficient savings to pay for out-of-pocket expenses. And lastly, always good to keep fit and stay healthy, especially if your plans rewards you with no claim discount. After all, it's better to stay healthy, right? Not having to make a claim.
Okay, thanks for dropping by, Eddie.
Thank you. My pleasure.
Healthcare costs are a big concern, especially as we get older and our health deteriorates. For now, it's still unclear if insurers will have to implement new measures to dampen claims. As policyholders, we'll need to take stock of whether we can afford our IP premiums when we no longer earn an income. As Eddie says, we also need to take responsibility for our health and the way we consume healthcare services. Unnecessary tests and procedures will take a toll on premiums for everyone. I hope we've given you insights to chew on. Until the next episode, thank you for listening.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.